let's go over a couple concepts real quick, and then I'm going to put that in perspective with the overall markets. So first thing first, what I'm gonna go over is candlestick analysis. All right. So when you're trading, right? I remember when I first started trading back in 2018, I used to use a lot of indicators. I used to use indicators. I used to use Fibonacci. I used to use uh Bollinger Bands, whole bunch of Christmas decorations that honestly you really don't need. So the biggest thing when we are approaching the market conditions is understanding price action. All right. Now, how are we going to understand price action? Right. So when we're looking at the markets, based off the markets going up, based off the markets going down, right? All that is price action. In terms of my charts, white is sellers and black is buyers. All right. Terminology, white is bearish, black is bullish. Okay. So in terms of understanding the market conditions and candlestick analysis, right? Want to understand, okay, cool. How is our candles forming? Are we seeing more are we seeing a lot of bullish price action coming in? Are we seeing a lot of sell price action coming in? And when we are uh putting these concepts together, right? Understand, okay, cool. In order for you to understand what potentially can happen in the future, you first got to understand what happened in the past. So looking at those concepts, right? We look to the left, we understand this is our last price point where price came in and overall created a new high, right? And overall, we are in overall uptrend. We see the markets creating those higher highs, higher lows, and overall those floors, these levels of support are being maintained. So when we're taking into account how our price action or our candlesticks are forming, we want to base that off our old price levels or levels of support. So we look at this area right here, right? This was a previous level of support. And then once price came back, gave us a retest, we see how this candle formed. So with that being said, before we even move forward, I first want to give some demonstrations so we can put everything together to make it make sense. So in a bullish structure, right, we're going to see higher highs and higher lows. In an uptrend structure, the markets create higher highs and higher lows. All right. And when we are at those higher low points, we want to see how buyers are reacting, right? Are we seeing those bullish engulfing variations, which are in this instance, let's say this was a level of support. All right. And then we overall see these sellers come to this level of support. And then we see buyers coming in. All right. So let's say this was hypothetically a level of support. All right. Now, once that level of support was formed, um, how was that candle forming at that point in time? So usually what we're going to see once a level of support, a major level of support, right? Once that major support is interacted with, usually what we see is situations like this. So let's say these was our candles. All right. And then once sellers came in and interacted with this point, we saw buyers come in right after. All right. So this would be an example of a bullish engulfing variation. All right, I'm gonna write this out. Bullish engulfing variation. All right. So that is one example of a bullish engulfing variation. All right. Then we might have a situation like this.
Hey, say, Keviron, can you explain what bullish engulfing variation means one more time for me?
All right. So to make it make sense, a bullish engulfing variation, it just signifies that buyers have taken control of the markets at that specific point in time. So typically we're going to see those bullish engulfing variations form from a major level of support. All right. And think of support
Okay.
like your floor.
Okay, yeah, that makes sense.
All right, cool. So this will be another example of a bullish engulfing variation. These two bullish candles right here engulf this previous bearish candle. All right. So this will be an indication in the markets where buyers have taken control from this level of support and overall where you could be looking for your entry opportunities. All right. Now, in terms of the last example, so we have a situation like this. This is called a doji. All right. And all a doji is, where is this? So all a doji is indecision in the markets, right? Price wasn't able to uh break higher and close higher or break lower and close lower. The overall close in the same spot that price opened at. So make it make sense. Indecision in the markets. All right. Then right after that doji candle formed, you had another bullish candle that came in. All right. And that's an example, another example of a bullish engulfing variation. All right. So let me draw this again for y'all real quick. All right. So these are our three examples of a bullish engulfing variation. All right. So if y'all want to draw this out or take a screenshot, go ahead and do that right now. All right. Boom. So moving forward, showing through live markets of what a bullish engulfing variation will look like. Um, so whenever we're approaching the market conditions, we always want to start from a higher time frame to get that bird's eye view, to get the clear direction of the markets. So I'm pretty sure everyone on this session has flew in the plane before, right? Now, if you have flew in the plane, let's say you had that window seat. So when you look down outside that window and you look at the full terrain, you're seeing everything. You're seeing, the overall full environment of the land. You're able to see the buildings, you're able to see the shapes, you're able to see everything, right? Now let's say that we were on ground zero. We're on ground zero right now. We're able to see the wildlife, we're able to see the signs, the lettering on those signs, we're able to see the cars, we're able to see people, the full details, right? So when we're correlating the lower time frame with the higher time frames, we're able to see or have that clear understanding of what the market is truly trying to show us. All right. So when let's say we're on a daily time frame and we're trying to identify areas in the market or where we could be buying from, because understanding already what type of trend we're in, we in an uptrend, right? The markets are creating those higher lows and higher highs. And in my last video on YouTube is actually on there that I went over structure. So y'all can watch that video as well. But with that being said, the markets are creating higher highs and higher lows. Now, when we are approaching the markets, we want to first understand what type of trend we're in. Then we want to understand where we are in structure. So are we at a higher low point or are we at a higher high point? All right. Then once we identify where we are in structure, let's say right here, this is a higher low point. All right. This was price came back down, created a level of support based off this level here, right here. And this is a prime example of what I was saying before. In order for you to potentially understand what can happen in the future, you first got to understand what happened in the past. So right here was a newfound level of support. All right, then price came back, retested that area, and then buyers overall came in with, look at this, a huge bullish engulfing variation, right? That shows a lot of buyers volume in the market, which signifies that potentially in the future, this is an area where buyers could be entering the markets again. And understand this, right? We're not the movers and shakers of the markets. All right. The movers and shakers of the markets are the banks, the corporations, and the hedge funds. So when we want to identify where in the market is where the banks, the corporations, and hedge funds enter the market, so we can capitalize on that opportunity. So we scale out to the daily time frame. We see right here, this was an old level support where if sellers, right, because we never know, everything is based off all probabilities. But if sellers come back to this area, this is a known area in the market where buyers could be building out momentum again to push higher, right? So let's go ahead and back test this area real quick and see where we could be entering the markets to take advantage of this move. All right. So when we are looking at executing the markets, we always want to base that off the lower time frame, such as like the 15 or the 5-minute time frame. Daily on the daily time frame, the 4 hour, well, the weekly, the daily, and the 4 hour, and the 1 hour, that just gives overall direction on the markets. And the 15 and the 5-minute, this is where we will be looking to execute, right? Looking at those fine details, again, ground zero, looking at the fine details to execute our entries. So this was right here, this was that area where once price or once sellers came back to this area or this level of support, which was, let me mark this off real quick. Boom, 1985. So when we scale into the 15-minute time frame, we see once price came to this price point, 1985, right? Not only did it reject from that area, but it also created a reversal pattern. So this is what we call a double bottom. All right. So this is point A, point B. All right. And this is our neckline. So whenever we see this formation be created in the markets, this is overall the indication or confirmation of getting into the markets or executing our trade in terms of taking buy opportunities. All right. Now, once price broke beyond this neckline, that was our indication again that buyers have taken control of this level. So with that being said, who can tell me in the chat, what is this right here? That's a bullish engulfing variation, right? So let's say we was looking at this, right? This was opportunity to get in. It was somewhere in the ballpark. But yeah, this is an example of a bullish engulfing variation. All right. So not only did we have a double top, hold on. First and foremost, number one, on the daily time frame, we are at a major level of support based off the daily time frame. Number two, when we scaled into the lower time frame, such as the 15-minute time frame, we saw double bottoms being created. That's confirmation number two. Number three, we also have rejections, right? Wicks. Personally, I look for 3 to 5 wick rejections. All right. So whenever we see wick rejections or these tails being formed from a major level of support, that is also another confirmation. So that's 4. Number 5, got a bullish engulfing variation. All right. So at that point in time, we should have no type of reason to not execute in that trade. Our stop loss also would be below here. All right. So let's say hypothetically, right, when we was looking at this trade or we was looking to execute this trade, let's say you had $1,000 account. When we were first entering the markets, we are not looking to just dive head first, right? On $1,000 account, you have your lot sizes, right? So let's say your lot size was a 0.05. So from here, from 1985 to 1975, that's 100 pip range. So in order for us to understand already off the rip, right? How much are we risking in order to see if this trade can play out? Because again, trading is all based off probabilities. We do not know if price can respect this area and continue to push higher, right? It easily can push below the zone and hit our stop loss. So to make sure that we are securing our accounts, we want to make sure that we have a stop loss in place to make sure, just in case it doesn't go in our favor, we're using calculator risks or we're taking calculator risks. So if it goes against us 100 pips, we just lost $50, right? But in terms of how much we're gaining $100, right? $50, $100, $150, $200, right? So let's say our target was outside of this zone right here, right? Let's say 2020. All right, so actually we're gonna do it like this. So that's a take profit area. This is also a take profit area as well. So we're gonna mark this gold. So again, the market all moves based on probabilities. We don't know if the market is going to do exactly what we are projecting it to do. However, when we are approaching the market conditions, we want to identify areas where we could be getting out of this trade if it does go left, or when we are in profit areas in the market where we could be securing profits. So identification number one, this is take profit one. All right. In order for price to push higher, it first have to break beyond this point. All right. If it doesn't break beyond this point, we're not getting up here. It doesn't make sense. All right. So, boom. This is take profit one. We see price overall broke straight through that. All right. So let's say from here to here, this was almost 200 pips, just about 200 pips. So 0.05, um, that's $100. So we just turned 50 cents to $100. All right. Type in the chat if y'all can use the extra $100. Type one in the chat if y'all can use the extra $100. All right. So mind you, that's what is 0.05. So um, let's say your lot size, right, was 0.5. So 0.5 is $5 per pip. All right. And I'm gonna write this down for y'all real quick too. This is another concept. So this equals 0.50 or 50 cent per pip. 0.50. So that equals $5 per pip. So let's say our account was, so before it was $1,000. Let's say our account now is $5,000, right? Um, let's say our lot size was 0.5, $5 per pip. In the same scenario right here, we caught 200 pips. How much money we just made on the same scenario? So we made on the 0.05, we made $100, right? Off 50 cent. So at $5, how much did we just gain? $1,000. So about a day, if you'd held this trade throughout the whole day, that would have been an extra $100 to $1,000 that you could have gained. All right. And that's just small scale. I don't want to go like above and beyond in terms of the lot sizes because at the end of the day, um, the money is cool and all, right? But when we're first learning how to trade or just learning the skill set, what we want to focus on is pips, right? Catching pips, right? When you're let's say catching 50, 100, 200 pips, if you've been doing that since day one, that shouldn't be a problem to do once you progress, right? And when you're progressing in a skill set, your volume is going to grow as your account grows and as your psychology grows, so is your volume. And note this as well. Trading, trading is 95% psychology, right? Trading is 95% psychology, and it's only 5% skill set. So in terms of, utilizing support and resistance, utilizing supply and demand levels, utilizing price action, right? All that is the skill set. But in order for us to execute, right, once we see those patterns or identify those different candlestick formations that are created, understand, okay, cool. Once price does come back to this price point, this is where I'll be looking to get into the markets. In order for you to execute on that trade, you had to have a sense of equanimity in terms of your mind, right? Equanimity, being at peace of the mind, having peace of mind when you're approaching the market conditions. If you got a lot of chaotic things going on outside of outside of, when you're approaching the market conditions, all of that is going to be translated into the markets when you execute your trades. So when you're approaching the market conditions, you want to make sure that everything's everything is aligned, right? Spiritually, you're aligned. Physically, you're aligned. Mentally, you're aligned, right? All those things matter when we are approaching the market conditions. All right. So yeah, with that being said, um, let's say, boom, price broke beyond this point. So at this point, if you was looking for a re-entry, this is not where you'll be looking to get it in at all. Never. Right? Keeping it simple. Buy low, sell high. So in order for us to look for areas in the market where we could be looking for new entries, right? This is point A right here. All right. Price can also, let's go to the 30 real quick. So this is the area as well. So point B, and it can come all the way back down here as well. Point C. But you see, once price did come back in, retest, right? Gave us a pullback. Price came right back to this old level of resistance. This was an area in the market where sellers came in and pushed price down, right? And then once price buyers came here, it finally broke through that level. The whole time, price was moving sideways. It was in consolidation. It had no clear direction until we finally broke out of that range. Then once price broke out of this range, we see what it did. What it did came back, retest that area. What do we see right here? Look at this, clear as day. 1, 2, 3, 4 wick rejections. Let's go to the 15-minute. Again, look, 1, 2, 3, 4, 5, 6 wick rejections. So all confirmations to get into this trade. Let's go to the 5-minute. Let's see if we can find a bullish engulfing variation from this area. Can we go back this far? All right, cool. Look at this. What is that? Boom. Bullish engulfing variation. So not only in the 30-minute we had a confirmation in terms of wicks, 3 to 5 wicks on the 30-minute. 15-minute we had 3 to 5 wicks as well. And on the 5-minute, we have a bullish engulfing variation that formed. So this is clear indication again that we can enter this trade and continue to ride it to the upside. All right. Now, in terms of our stop loss will be, again, right here. But instead of, and again, we want to make sure that when we're approaching the markets, we identify our risk. So when we execute this trade, our risk should be less than what we initially was risking before, right? So that means now our lot size has to be lower. All right. To make sure, because at the end of the day, family, you want to be able to give price breathing room because it can come again, it can come way back down here. It have all this range to play with. All right. We don't know if price is going to, let's say, create a level of support right here and then continue to push higher. We don't know that. All this is again all based on probabilities. So when we are approaching the markets, we want to already have things in place for the just in cases. Right. Now you see right here, we had clear momentum, a price overall continued to push higher. It never came back to this point. And yeah, we just been in an uptrend ever since, even to the point where gold created a new all-time high. Um, right here, this was December 1st, 2023. Gold created a new all-time high of 2149 or 2150. And this month, you see gold just created it just broke all through those levels. Like crazy. Beautiful time that we're living in right now. All right, so with that being said, did that make sense to did that make sense to everyone? Does anyone have any questions in regards to those concepts? Bullish engulfings, wicks.
Could you do one more example of the of calculating like the pip, how you turn 50 cents basically into a band?
All right, cool. So I'm gonna give you a more thorough example. All right, so let's say 1.00. So that equals $10 per pip. So I'm not a financial advisor or anything, but I would say if you had a $10,000 account, um, it would be cool to use a standard lot order. When we are approaching the market conditions, personally, I only risk 1 to 3%, no more than 5%. So if you have let's say you have a $10,000 account and you were risking, let's say, 10 to 30 pips. That equals, right, $10, um, 10 pips. So 10 times 10, 10 times 10, that equals $100. Let's say 10, that was your volume, which is $10 per pip, and you were risking 30 pips, that equals $300, right? So that's how you overall want to break it down. Now let's say in this case, you put in a standard lot, and right here you was risking 33 pips, right? Max 50 pips. So $300 to $500. So when you're looking to find areas in the market where you could be taking profit, you got this high right here. All right. Now let's say this was your entry and you put in a 10 lot order, right? And this was where you was looking to exit the markets. So you see right here, 100.3, that's 100 pips. So the market goes into your favor 100 pips, and your lot size was 10 lot. I'm sorry, not 10 lots, one lot, right? And that equals $10 per pip, and we caught 100 pips. How much money did we gain on this move? Kavets, no answer this. You know this.
1,000.
You said how much?
1,000.
So yeah, it'd have been $1,000 that you would have gained on this move. So yeah, fam, that was examples, multiple examples of a bullish engulfing variation. Now, what I'm gonna show y'all real quick is an example of a bearish engulfing variation. And you're primarily going to see bearish engulfing variations in a downtrend structure. In an uptrend structure, you see bullish engulfing variations, right? In a downtrend, in a downtrend structure, the downtrend, you're going to see bearish engulfings. All right, let's get it. All right. Bearish engulfing variations. All right. So let's say this is buyers, right? They're creating those higher highs, higher lows. And then we get an interaction from this supply level, right? Or a level of resistance or our selling. This is an area in the market where we could be looking for sellers to enter the markets and create those bearish engulfing variations. All right. Boom. So in a scenario like this, so let's say we got buyers stepped in, buyers. All right. Then right after they interacted with this level, yeah, sellers can come in. Boom. I'm gonna erase that. All right. So this would be an example of a bearish engulfing variation. All right. So you got these two bearish candles that engulf this bullish candle. Bullish engulf, bearish engulf. So let's say same scenario. Buyers came in. Then right after we had Doji. All right, then after this Doji form, we had a bearish candle that came in. All right. So this is also another example of a bearish engulfing variation. All right. And also taking into account whenever we do have a doji or a candlestick of indecision that comes in, what we simply want to do is just scratch that out. Literally, scratch that out. It's nothing there. We're gonna act like that's invisible. Same thing on our bullish engulfing variations. Scratch that out. All right, then last one. This is pretty much like the standard one. Simple. Bullish candle. All right, then once this bullish candle formed, we had sellers come in and create a bearish engulfing variation. These two candles right there. All right. So whenever we see that, this is also another indication or indicator of confluence in the market or where we could be looking to sell. All right. Once this forms, entry, sell. This forms, entry, sell. This forms, entry, sell. Stop loss above here, stop loss above here, and stop loss above here. All right, so these are our examples for our bearish engulfing variation. All right, so all this right here was resistance or our selling. This is an area in the market where we could be looking for sellers to come into the markets once buyers, right? Once buyers come and interact with this level right here. All right. So let's do this. Let's analyze this area right here and see how we could have taken advantage of this move in the past. So this is that 2080 area. So on the 4-hour time frame, we had a bearish engulfing variation form right there. On the 1 hour, look at this. You also had a bearish engulfing variation that form right there as well. 1, 2. Y'all see that? 1, this bearish candle, this bullish candle right here. And then we had a formation of these two candles right here that engulf this candle. Right? It engulfed this candle right there. So once price created this, that was an indication of where we could be looking to sell. All right. Now let's go to the 15 minutes time frame. That was 2080. Here we go. All right, so we had a zone. All right. A range that was created. So we had multiple entries or opportunities to get into this trade. So right here, this was entry 1. These two candles broke beyond this point here. This was opportunity 2. This candle, this bearish candle alone broke beyond this candle here. All right. And this was the last opportunity before we saw price drop, which is right here. All right. So this is our 3 entries. Entry 1, entry 2, entry 3. Either of those entries would have worked, and our stop loss would have been, let's say, 50 to 100 pips. All right. So from this was 2088, so our stop loss could have been at like 2098, just to give the market again room to breathe, just in case it does go against us initially. All right. And to do that, again, you want to make sure that you use proper risk management. If you don't, then it can get quite ugly in the process. Very ugly. All right. But yeah, you see price never broke beyond that point once that direction was solidified and that momentum was built. And we see price went in our favor. This was TP1 right here. So from here to here, that was 100 pips. All right. So we had a 0.5. That would have been $500. If we had a standard lot, that would have been $1,000. If we had a fallout order, that's $50 per pip. That would have been $5,000, right? If we had a 10 lot order, that would have been 10K. If we had 20 lots, that would have been 20K, so on and so forth. All right. And that's how we can tie in bullish and bearish engulfing variations in order to execute trades in the markets. All right, anybody got any questions on that?
Yeah, I got a question. Can you show me like I know the pips, this, that, and this and that. Like what it was like if we would have lost, like we would have lost. How I can control my risk on that. Basically.
All right, so when you execute your trades, you're gonna have something that say TP. You're also gonna have something that say SL. So your SL is your stop loss. All right. You can look at it like that's your safety net, just in case price goes against you or the market goes against you. That's your safety net to get you out of that trade, so it doesn't wipe out your whole account, so you don't blow your whole account. All right. So in order to set that, you want to identify in terms of how many pips you're willing to risk. So let's say you were trading gold. In this example here, let's say we got in at 2086. Now price went all the way against you, let's say to 2090, right? From 2086 to 2090, that's about 40 pips. Hold up. That's 30 pips. So let's say your not your stop loss, but your lot size was a 0.10. That's $1 per pip. So the market went against you 30 pips. How much money did you lose?
Is
From
that $30?
2086 from 2086 to 2090. If price went all the way to 2090, how much money would you have lost on that trade?
$30? If I put in a
$30.
dollar? Yeah, okay.
$30. So when you execute that trade, you're gonna see stop loss on there. So your SL, that price point will be in that example, your price point will be 2090. So just in case if it ever happens, if it went to 2090, it will automatically take you out that trade. And you would have lost $30. But in terms
Okay,
of how much you can, yeah, but in terms of how much you can gain, let's say you put your take profit right here at 2075, you would have gained over 100 pips.
okay, and that would have basically from a dollar would have got me $100.
Yep. So you'd have been risking $30 and gaining anywhere from $100 to $120.
Okay, and also when I put my stop loss and my take profit, I can when I've been doing it, I've been using that little ruler. Is that ruler
Uh-huh.
helpful at all?
Yeah, the ruler's helpful.
Okay,
Yeah, this overall measure the markets for you. And yeah,
okay, I was just asking.
it tell you how many pips um that range is worth. So from 2085 to 2064, that's 208 pips.
Okay, I see what's going on.
Yep.
Thank you, bro.
All right, bro. But yeah, if anyone doesn't have any more questions, definitely next training call gonna be next Sunday. We're gonna be doing these every Sunday around the same time, Monday through Friday at 9 a.m. We're gonna have live session calls during New York session. Taking live calls from 9 a.m. until 11 a.m. So if y'all haven't already, go ahead and set up y'all Sway account and I can show y'all how to deposit money to your account if you're ready to go that route, or how to set up your demo account and also set up your sway charts as well. So you can start executing trades as soon as possible. All right. So yeah,
All right,
with that
brother.
being said, y'all
All
can
right,
either
yo,
catch
thank you so much.
yeah. Y'all can either catch me at the beach or the bank, y'all.